Hey everybody, it's James here from Mogul Mastermind. I've got Shawn Maslyk here. We are doing his post-Mogul Mastermind Q&A. We noticed that there were a lot of really good questions for Shawn that came out of his presentation. So here for the online component of our Mogul membership, we're going to do a deep dive into some of these questions and get really granular and specific. Shawn, how's it going?
I'm doing very well. Thanks
Awesome.
for having me out, James. And like I said, when I was presenting, I always get full of energy coming to those the Mogul Mastermind groups. You guys have done an excellent job of creating such an energetic crowd, and yeah, I'm happy to be part of it.
Awesome. I appreciate the compliment, Shawn. So the first question we had, you in your presentation talked about a money assessment that people can take. And we got a few questions about what's that all about? What are they going to learn from it? How does it work? I know I've taken it, but and I really appreciated what I learned from it. But for people that are curious, what the heck is that all about? Let's get into what that test is all about.
Yeah, you know what? I was, I guess not surprised, but I also received a lot of emails about how to complete that money assessment. And I think it's so important when we're looking at our wealth, we really take a step back to first identify, why am I making money? What's the point of me making that money? And then once we identify that, to really look at ourselves and look how we handle money. And I think that's often something that's overlooked, and everybody has a different experience based on their upbringing, on how they view, how they perceive, and how they react around money. So what this money assessment does, it helps us get insight on the unconscious behaviors, the unconscious feelings that we have around money. So often people have no idea why they can't budget, why they can't pay their credit card off, why they can't just sit down and look at a financial plan. And often it's rooted in these what we call money scripts that were developed basically when we're 3 to 5 years old, when we watched our parents deal with money, when we saw them fight or not fight around payday, and all the different experiences that we had around children and money. So there's a psychologist and a certified financial planner of the States called Dr. Brad Klons. He created this money script that is just phenomenal. And he's got a free resource for a money assessment. And I'm happy to share that link with anybody who wants it. And what it's going to do, it's going to ask you about, I think there's about 15 questions.
Okay.
And then from those questions, he will give you what your money script is, what your money tendencies are, based on hours and hours of research, in-person surveys. This assessment is extremely thorough, and there's 4 key money scripts that come out from this assessment. Number 1 is a money avoider. That's someone who just avoids money. You don't want to talk about it. It gives you stress, anxiety. You just avoid it at all costs. Number 2 is a money worshiper. This is somebody who believes that the net worth is their self-worth. This person puts a lot of their energy, sacrifices a lot of their personal health, their personal self-care for money, because they truly believe that self-care, their net worth is their self-worth. Yeah.
Right.
And the next one is money status. These are people who believe that money equals status. So these tendencies are usually people buying nice vehicles, nice clothes, nice accessories, and not because they appreciate necessarily the craftsmanship that went into that product. More so, they like the feeling it gives them when they walk into a room and they feel like people are looking at their accessories. Right. And the last one is called the money vigilance, and this one's a little different than the other 3. This one is individuals who have a hard time parting way with their money. And on the surface, this one sounds like, oh yeah, this is the best money script. But often there's a lot of stress that's related to money vigilance, because you can't part way with your money. And then you also do silly things, like maybe you actually don't pay your bills in time because you don't want to actually depart with your money. So to answer your question, these money assessments give us insight on our money scripts, on our relationship, on how we deal with our money. I mean, if I like running, so I went and saw a running coach to tell me what are my poor running tendencies. so I can get better. This is the same thing, but arguably more important.
Okay. So
And
the
that's what I
test,
got for you. That was a rant, but
no, I get it. So the test that we're looking at and the test that these people are going to take is going to identify kind of in broad strokes one of their four money stories and what money stories and scripts they typically tend to fall into.
that's correct. So out of all four, everyone has a tendency, well, I shouldn't say everybody, the vast majority of everyone has a tendency in each script, but you're going to have a dominant script.
Mm-hmm.
And it's going to, and then also suggestions on how to make better decisions when you have that tendency. It's not a bad thing to have one of those tendencies once you understand what you can do. And that assessment is going to give you all the information, and he gives a whack load of information.
Okay. So the whole point of
and it's all automatic. It's quick.
Yeah. So it's just insight on what your general money tendencies are, so that, you know, when you're making money decisions, you know what your tendencies are and you can kind of make better choices around how you receive and spend money. Is that kind of the idea behind that test?
Yeah, it's our brain is the master of everything. And if we don't understand our brain and what our tendencies are when we make money decisions, we're going to take on more risk than we need to. If I'm a status seeker and I go to a rain or whatever real estate event,
Mm-hmm.
and someone's on stage talking about, I don't know, some sort of multifamily deal that's awesome, or they have 300 doors, I might feel that I need to now go get all those doors to show my status in that event.
Right.
But if I'm not aware of that blind spot, that I'm just doing this to seek status, I might put my entire financial health at risk.
Right.
So once we get insight on what our tendencies are, we can then make informed decisions. I feel like a lot of times we get informed with the facts, the numbers, the cash flow, the ROI of the property, but we might not be making a rational thought based on the actual intent of why we're buying that.
Yeah, like what's the psychology behind this?
What is the psychology? And we're in information
with my goals kind of thing, right?
100%. I feel like psychology in money behaviors, in eating well, in exercising, anything is the key to success. We have the most information we could ever dream of right now, whether it's real estate, exercising, whatever it is.
Mm-hmm.
But why don't we do it? Maybe it's because we don't know how to actually get our brain to do it. And that's the psychology. So this is answering the psychology behind our money behaviors so that we can enjoy our wealth today, tomorrow, and in the future.
Cool. Okay. Well, I appreciate you clarifying that, because a couple of people were asking what's this all about and why is it important? So for those of you that haven't taken the test yet, I mean, I took it, and it's kind of one of those things where as soon as I was reading it, I started recognizing behaviors and patterns in myself, and I was like, okay, yeah, that's really interesting, and it gives you some helpful suggestions. So I enjoyed it, and I appreciate you clarifying it.
Can I give an example? Because I think this is the key to anything. So I'm training again for an Ironman, and I hired a new coach, and she saw me swim, and she video cameraed me in her GoPro, and I was trying to do the best. I was like in the water. I'm like, I am nailing this right now. And after she got up to me and she said, you know what, Shawn, until we start your swimming program, I think you should stop swimming. You have such bad habits.
Wow.
And I thought, wow, really? So now I'm a month into her swimming program. She's like stripped me down to like, she does down each skill. And I actually was swimming this morning. And after a month, I can swim faster than I've ever swam before it sounds silly, without even like actually trying, because she taught me the techniques that I need to know. And there's a lot of things going on in your brain when you're swimming. But this morning, I'm like, everything's starting to click. I understand the shoulder extension, blah, blah, blah. But without taking the time to understand like the technical side of it, I would have just kept blindly going off into my own swimming way, thinking that I know what I'm doing, but I don't.
Mhm.
So she's basically broken down. She's done like swimming scripts for her brain. So, okay, I'll leave the subject, but I think it's so important.
I know. I'm fascinated by it too because you're right. There's whether it's fitness, finance, real estate, the information is decades, if not centuries old, and all the information is at your fingertips. So it's like, for people that are asking themselves, "Hey, I know the principles here, but why aren't I taking the action that's in alignment with the principles?" Getting a little bit of insight into your own psychology can help answer those questions, so that you can start working towards, you know, changing your mindset, which is what we talk about. Change your mindset to change your results. Like this helps you define that mindset as opposed to having kind of like wishy-washy concepts like, oh, I don't know, maybe it's because I'm lazy, or maybe like you can almost create self-defeating scripts. And it's like, well, it's not because you're lazy, it's just because you view money in this way. And so when these types of scenarios arise, your knee-jerk reaction subconsciously is to do this. So once you can once your rational brain identifies the pattern, then you can start moving your subconscious in a direction. So I'm pretty into that idea. It was really insightful to talk about, and I don't think, we didn't get a chance to really expand on that during your presentation. So that's why I think that question came up quite a bit. Okay, I'm switching gears. I think we really hit on that question, and I think that's an awesome answer. So the next question, the reason I keep looking down, by the way, is because I have my little question list written out. As I was walking around the networking event, I just like made little scribble notes as people were asking questions. So the next question is, everybody there is into real estate, and most people there have a portfolio that's heavy into real estate. And the question that kind of came up is, okay, as a real estate investor, my financial plan is to buy a ton of real estate. Why do I need a financial plan? Or for people, so I'm asking it in a two-part question. So this is going to give you kind of a launch point to just talk, and I might ask some follow-up. But then the second question is for people that understand the value of having a financial plan in real estate. The question is, okay, how does real estate fit into a financial plan? Because most traditional financial planners, when you go in there, are going to talk about, stocks, bonds, mutuals, RSPs, securities. Real estate doesn't enter that conversation. So, step one, where does financial planning fit for someone who wants real estate to be their thing? Let's start with that.
Okay. So for me, a financial plan, and I mean, of course I'm biased, I'm a certified financial plan, but a financial plan is, outside of understanding your financial why, your money scripts, the next most essential thing, because it's a roadmap. We call it a financial roadmap. It's gonna create clarity around your goals, document all your goals with dates and deadlines of when you want to reach those goals, which is good for envisioning them. And then it organizes all 6 key areas of your financial life. And to me, that's an incredibly important part, especially when we're using our investment tool of choice is real estate. Because what I have found is when we organize, it doesn't matter if it's like investments in the stock market or real estate. When we organize everything, we stop bleeding out high interest costs or unconscious money being spent that we don't realize is being spent. So again, when we organize someone's financial plan, we look at taxes. So taxes from investment side. Are we taking advantage as much tax opportunity as possible? If we can save the client 3, 4, 5%, if we can use a different corporation structure to own some real estate, and of course in collaboration with their CPA, then we're saving them money, which is going to grow the portfolio. So number one is we look at tax from an investment perspective. Number 2 is the investment. Do we have the best investment for your financial plan? And in your conversation, this is real estate. So sure, real estate is just an investment. A financial plan doesn't mean you need securities and stocks to be in your financial plan. You just need an investment. So on the investment side, we look at, does it have the appropriate risk tolerance? For us, risk tolerance is so important, right? Because risk tolerance defines how much risk you can take. And if you take too much risk, everything can fall apart. But if you don't take enough risk, you're not going to get where you got to go. And then another part we look at is risk. What kind of risks are associated with this investment? So real estate, we would work with the client to talk about what kind of risk you have. Well, you have market risk, you have inflation risk, you have tenancy risk, you have physical damage risk. We go through all the different risks and then talk about ways to mitigate them if possible. And, we do look at a financial plan does look at estate planning, because at some point we will all pass away. And what does that look like? If we have a premature death, for example, me and my wife, we invest in real estate thanks to Mr. James Canal about 10 years ago. And we have a mortgage on every single property. And if myself or her were to pass away, there's a substantial risk for us to maintain the same standard of living because we have all these debts. My wife does not like investment or real estate. So, for example, we'd utilize a life insurance policy to pay out that debt for my wife. That's an example of understanding risk and mitigating it, particular to real estate investors. And then we look at cash and debt flow. So how much cash flow is coming into the client's account, and are we utilizing it as much as as efficiently as possible? And then debt, how much debt, again, are we paying down that debt as fast as possible if it's got a high interest rate? Leverage is a beautiful thing, but also if we assume too much debt, now we're on the side of risk. We might not be able to afford the debt repayments if the market turns. So a financial plan also looks at debt. So to answer your question, a real estate investor, from my perspective, can certainly benefit from clearly articulating their goals, clearly articulating what they want out of their financial plan, documenting, and then organizing tax, investment, insurance, estate, risk management, and cash and debt flow.
Got it. So, I mean, it's as for the real estate investors out there, I mean, we think about real estate as getting into a business. And that's, I'm just going to build on what you're saying, but, it's like when you're in real estate, it's not really a passive investment. Most of the time it's active unless you're a cash partner in a joint venture. And even then, there's some activity involved with it. So, I mean, that's pretty reasonable to kind of wrap your head around. Now, from my perspective, it's still important to actually plan what to do with the money once you make it, which is kind of the point you're making. The reason we get into real estate investing is to create equity and net worth and cash flow for ourselves. So, okay, you've got this money. What's your plan? That's the missing link that I think a lot of people miss out on when they start investing in real estate is, yeah, okay, we're going to make some money, but then what?
Mm-hmm. And what do you expose yourself to if you start making money? Too much risk. And what happens if you assume way too much risk and you make a bad call, which will happen, and you can jeopardize a lot. We had a client who had no idea how much, what their net worth actually was, and they had about 50 properties in Saskatchewan, and they ended up going even bigger. They bought like a trailer park complex, and it just tanked and tanked and tanked, and they ended up losing a few $100,000, which dramatically impacted them and put them from like 80% where they need to be, like down to like, I think it was maybe 65%. So, and they were young. So the point is, they didn't understand. They just collected a whole bunch of properties. And for most part, the people I talk to, they don't want to collect like investment certificates or real estate. They want what the real estate investments are going to do for them. But if we actually don't organize and understand where we're at, right, then we might collect the wrong real estate and just throw our whole portfolio off.
Yeah, exactly. I you know what, that's a keen observation, and you're right. I mean, it doesn't matter how savvy of a real estate investor you are or what market you're in. Markets are cyclical, and despite your best due diligence, some properties are just duds, and it's important to have a big picture management to that risk. So let's so we kind of touched on that risk management. I'm going to switch gears again because this was another separate question that somebody had. Somebody wanted me to ask you about life insurance, because I think for people that haven't researched life insurance, it's kind of confusing because there's three kinds. There's term, whole, universal. What do they mean? Some people have a negative view of life insurance because they think, oh, it's, why would I pay for something I don't plan on dying? Which I mean, everybody dies, but that's besides the point. Mm-hmm. But more so, it's not really a debate as to whether or not it makes sense for life insurance, but what is it? How does it work? And like, what's the difference between the three kinds?
Yeah. So what is life insurance? I mean, life insurance is the way that financial planners mitigate risk within the financial plan. And what that means
Right.
is if our plan is to save up $5 million for a couple at 50 years old, and one unexpected thing happens and there's a death at, say they're at 35 and they're only 30% away there. And let's use real estate investor this example.
Yeah.
So they're 30% away to their end goal.
Yeah.
There's a death, and maybe it's the person who manages the portfolio, and they have about $1.6 million of mortgage, let's call it. Now that surviving spouse still has a goal of $5 million net worth at 50, but has a severe disadvantage now because they have to have $1.6 million of debt to be paid out. Often I hear, well, you know, the properties pay for themselves. I can tell you from the clients that we deal with who have real estate, it is hard when one of the spouses pass away. And I mean, we probably deal with 20 death claims a year, and it is a hard situation to be in that mindset to, oh, wow, I have to manage this all by myself. So one thing right there is,
yeah, real estate, there's a lot of debt. Mortgages are big, hundreds of
there's a
thousands
lot
of
of
dollars.
debt.
So insuring that debt, if there's, you know, if there's a death, then it makes sense. I get it. So let's get
in this
into
example,
like, so let's talk about term, universal, whole.
yeah,
What's the difference?
in this example, I would be recommending these clients, most likely, you got to talk to them, but a term insurance. Term insurance is, as it sounds, it's term. It has a set term. It could be 5, 10, 15, 20, 25, up to 30-year terms usually. It's inexpensive because you probably will never use it. Usually it's like a 1 in 120 policies pay out because most term insurance expire at the furthest possible date of 85 years old, which is lower than life expectancy. So that's why it's so inexpensive. Term insurance is great for temporary debt. That's why it could benefit a lot of real estate investors. It doesn't cost that much, and you can get a lot. If there's a death, well, there's a lot of insurance. Then we have permanent insurance. Permanent insurance lasts for a lifetime, as it sounds, permanent. There's two main types of permanent. One is whole life insurance and one is universal life insurance. I don't think we'll get into the weeds of the differences, but basically each of those policies, you pay a little bit extra. So it's no longer called a premium, more so a deposit. And the insurance company builds up cash value within your insurance policy. Whole life, builds it up through dividends through the company. Universal life will invest that money through the regular stock market.
Okay, so I'm just going to reiterate what you're saying to make sure everybody understands. So term life, you're just paying for the insurance. Universal / whole life, you pay a little bit of extra money. That money goes into a pool. That pool is then invested so that it can grow in value. And then in addition to the amount that you have insured, there's a little bit extra that goes into it that you're saving progressively every month with the amount that you're paying towards your insurance policy.
That's correct. And I mean, who these are for, it depends 100% on the person. But generally speaking, these are people who are going to have maybe some large taxes at death, some capital gains. It's a good way to grow your cash value tax-free. Life insurance is paid out tax-free, and it pays out tax-free.
Okay, so let's pause on that because that's an important point too. So as you're paying, you pay your life insurance in case you die, you pay a little bit extra towards the savings for when you die. When you die, that all that money that grew, 100% of it gets paid out without tax.
There's an adjusted cost basis, still like a house. So there's an adjusted cost basis test, but generally speaking, no, life insurance is tax-free. The cash value, you got to do a cost basis to determine how much is going to be 100% tax-free.
Okay.
But the death benefit, just so you're clear, the death benefit is always tax-free.
Okay. So if I'm hearing you correctly, let's say that I take out a $500,000 life insurance policy. If I die, that $500,000 gets transferred to my estate tax-free. That's how that works. Now, if I've got a $500,000 policy for when I die. The $500,000 is tax-free, but if I've saved up another $500,000 for a total of $1 million that gets paid out, the second $500,000 may have a taxable implication.
May have a taxable, yeah. And
Okay.
your life insurance policy specifically outlines how that calculation is done.
Okay.
So you'd have to talk.
Okay. So if somebody wanted to use it as like another savings vehicle, that's kind of the idea in a way.
It can. I mean, again, it needs to be looked at everything. Some people just go automatically to these policies. I believe in looking at everything, but it can.
Now, the other thing that I've heard, and this was kind of a follow-up question, is that if you spend enough time in your life insurance policy, you build up a big savings portion of your life insurance policy, that can actually be used as a collateral for a loan. Is that true?
Yeah. So it's called an insured retirement plan, where people will overfund their policy, so pay like an additional amount. And what that does is it increases your cash value even quicker.
Right.
The money is invested and it gains interest tax free. Then you have what we call the cash value, and if it's worthwhile for a bank, you can go to the bank and they should, and most insurance companies have an agreement with the bank, leverage out you money. So it's almost like a home line of credit against your life insurance cash.
Right. Yeah.
So it grows tax free. You take it out tax free, but you're going to have an interest rate loan. Yeah. Which could.
Yeah, it's a home equity line of credit, but instead of your home being the collateral, the cash value of your policy is the collateral. Got it. Got it. Okay. So that's how that works. Okay. So I think that kind of clears up the whole life insurance question. I think that's it. That's it on my question list. Were there any other questions that you were getting asked at the networking break that you think need to get answered?
No, just sorry. I don't want to beat that down. One little caveat is we're going to talk to someone who knows the policies inside and out, because they can sound very, very attractive, but we always have to be very attentive over the tax implications. So just a caveat. I'm not giving specific advice. My advice is go talk to someone.
Yeah. Okay. So the tax, and I'm not giving tax advice either. Obviously, we're just talking about how life insurance, there can be a tax benefit to putting money into that policy and check with your accountant, kind of thing. Cool.
No, there's no other thing other than I actually met with one of the attendees already, and we did what we call our money gap assessment, and it takes us about an hour, and it just gives someone a 360-degree feedback on their financial plan. It identifies, as the name suggests, money gaps. Any gaps you see right away. So I think it's a great exercise for anyone to go through.
Right. Okay. Yeah. So I mean, if you want your money gap analysis, Shawn, I'm assuming you're the guy to talk to.
You can do that.
Cool. Okay. Thanks for the Q&A, Shawn. I appreciate you adding a little more elaboration to some of the points in your presentation. And thanks for giving such an awesome presentation. We'll see you again next time.
Thanks, James. Bye.